Yes, we are recording this. I'm going to share this with Guelph District Association of Realtors, and hopefully we can they can distribute it to those people who weren't able to join us today. So today's topic is what's the best way to finance a secondary home, and I'm just going to talk a little bit about 3 different areas, and then I wanted to spend the last maybe 5 minutes just looking at what's happening with interest rates and talk to you a little bit about just what recently happened with the 5-year fixed rate. So what I have scheduled today is probably about a 20-minute conversation. If you do have any questions, please include them in the chat. I'll keep my eye out for them. And then let's just say the last 5 or 10 minutes, we can look at the different rate sheets that are available right now. And I can talk to you a little bit about the bond market and how that's affecting 5-year fixed rate mortgages. Okay, so let's just get started. I'm going to do a screen share here with you guys. So the topic for today is really how to purchase a secondary property or even more. Just so you know, like we've got a lot of experience in working with people who want to buy a secondary home. And I myself have a few different properties that I've owned over the few years. And so one of the things that I think you'll appreciate and your clients will appreciate is that we actually have firsthand experience. So I've been doing this for most of you guys know that I'm the principal broker with the Mortgage Center. I've been doing this for 20 years and I think I've financed over 11,000 properties. So one of the things that when your clients are working with us, they actually have that level of expertise so that someone can help them structure the purchase in the right way, in the way that's going to benefit them the most financially, and also going to help them get ahead financially. So we're going to actually look at 3 different properties. You know, lots of people right now, I was just reading in the Financial Post this morning, you know, a lot of people are fleeing the cities, looking at purchasing a secondary home or a cottage. It probably is, you know, fleeing from the city, from the GTA is probably short-lived. It is unsustainable because eventually people will have to go back to the office, which is what I believe. I've heard also a lot of economists talking about that. The other thing that we're going to look at is financing a secondary home for a child or parent to live in. And then the third option is going to be how to purchase a rental property. And I'm going to kind of do a little bit of a analysis for you just to show you what some of the simple calculations are to do that. So let's get started. So financing a cottage, this is really interesting because I have heard you can actually buy a cottage with only 5 to 10% as a down payment. And people say, well, how is that possible? And I mean, you have to qualify, and it's not actually specific to any financial institution. So I have heard a lot of bank people talk about, oh, this is a specific product to this bank or this bank. It's not a specific product to a particular bank, but it is actually a program that the default insurance providers provide. And so you may have heard of Genworth Financial. They have actually done a rebranding and have changed their name to Sagen. I think that's how you S-A-G-E-N. So if you just do a quick Google search on Sagen, which is now the new Genworth Financial, they provide default insurance on cottages. And remember, in Canada, most of the time when you have less than 20% as a down payment, the mortgage has to be insured against default. And so we've got Canada Guarantee, Sagen, and CMHC, Canada Mortgage Housing Corporation. Those are the 3 institutions that provide the default insurance on most financing in Canada. And so when you're purchasing, so we're talking about cottage properties, and when you're purchasing a cottage property, there is a program with Sagen, who insures these properties with only 5 or 10% as a down payment. Now, there are 2 different types of properties. So there are A-type properties and B-type properties, and let me explain sort of the main difference. An A-type property would be a property that you can live in year-round. B-type properties tend to be like cottages on islands where there is not a road access, and most of them don't have like a second, like a heat source. So for B-type properties, you could get away with 10% as a down payment. With A-type properties, you can get by with 5% as a down payment. So one of the things, though, when I do talk to people about purchasing a cottage, or they've called me and said, how do we do this? There is a default insurance premium that's added to the mortgage, and it's very similar to when you're buying your first house. So with 5% down, it's 4% of the total loan amount. With 10% down, it's I think it's 3.15% of the total loan amount. So I always recommend, especially now, home values are a bit puffed up. It might be better to look at accessing some of the equity in your primary residence so that you can come up with the 20% as a down payment, just so that you could avoid the default insurance premium. So that's sort of the first topic of discussion, is purchasing a cottage. And remember, you can buy a cottage with 5 to 10% as a down payment. It is going to be insured, but you have to qualify. And so when I say you have to qualify, these are people that have really strong income and good credit history and not a lot of debt. Okay, so if they don't have, if they're self-employed, if they don't have good credit, if they have some debt, probably not a program that they're going to be able to qualify for. The next thing I wanted to talk to you about, and I've just actually spoken to someone yesterday about this, they're getting ready for their child to go to college or university. I think it was university, and they're thinking now about buying a condo for their child to live in. I think, you know, given the pandemic, living on campus in student residence is a little bit, it's kind of questionable now, right? So I think you're going to find that more and more parents, if they have the financial means to, will be looking at buying properties for their kids to live in when they go to college or university. So again, this is a program where you can, if you qualify, you actually can purchase a property for your son or daughter to live in with only 5% as a down payment. Now, this would be a townhouse or maybe a condo or possibly a small home. It would not be a purpose-built student residence. So for those of you who are joining us today who are realtors in Guelph, I'm not talking about those purpose-built student kind of rentals that are on near Gordon, and I think it's Gordon and Arkell Road. We do actually have quite a few of our clients purchase properties that are existing student rentals, and we actually have partnered with a financial institution called Wealth One Financial. And I mean, you can check them out online. They are a chartered bank, and this is why they can do it. They will finance student rentals. And the type of student rental that they are looking at are, it's not a legal lodging house. It's a home that's in a subdivision that could not only be rented to students, but also could be rented to families. So there are very few options for purpose-built student rental financing. We have actually been doing them through privately, and or possibly looking at the people who are borrowing the money and helping them access the equity in their homes. So that's the second thing that I've just mentioned to you is you can also buy a property for your son or daughter to live in, or even your parents to live in, or if you have clients who want to purchase a property for their parents to live in, with only 5 to 10% as a down payment. And keep in mind that if you do have clients that are buying a house or wanting to buy a house that's an existing student rental and you're not going to get vacant possession, we do have good financing options for that. So just to kind of give you a little bit of idea on the interest rates, right now interest rates are somewhere between 2 and 2.5% on a 5-year fixed rate mortgage. I know that's a big surprise for you because those of you who joined us last month, they were under 2%, and I'm going to tackle that just in a few minutes. But on the student rental side, you'd probably be looking at somewhere between 3 and 3.5% on a 3 to 5-year fixed rate mortgage with 1% fee. So that kind of helps you there. Now, I also wanted to let you guys know that if you do have any questions, please include them in the Q&A, or even if you wanted to, you could also just ask a question in the chat. So I'm going to keep my eye out for that. So the last thing I wanted to talk to you a little bit about is how to finance a rental property. Now, I think most of you, you're real estate agents, so you know about the idea of cash flow, but let me just share my screen with you for a second. And we can, I wanted to run some calculations for you guys. So give me a second here. Let me do a screen share here. So I wanted to show you the equity calculation for purchasing a property and how to access the equity in your house. So most of the questions we get on rental properties, and most of the people who contact us do have some money saved. But when you purchase a rental property, to get like sort of the best type of financing, you need to have at least 20% as a down payment. Now, there is some grumbling that might increase, the down payment on rental properties might increase, but for now it's 20% down. So most of the time I advise clients, again, depending on the cash flow of the property, to look at the equity in the house and see what they have there. So this would be a very typical example of a conversation that I would have with a client. And so let's just say a client has, and I hope you guys can see this because I think you can. I'm going to share my computer screen, and I noticed that there is a question that's come up. I do have a question from a panelist, not from a panelist, but from someone who's attending, and the question is, there have been some difficulties when there is a common ownership on the entire property. Can you comment on that? I am not sure what common ownership is, actually. I have not heard of that term before. So maybe you can clarify that in the chat box, and then I can get to that. So let's look at the equity calculation. So let's just say you have a client and the estimated value of their primary residence is roughly about 800 grand. And so what I'm showing you right now is just a very simple calculation of how to determine how much equity your clients have. And this is something we would have and what can be used as a down payment. So again, you can refinance up a property up to 80% of the value. So, I mean, the math is simple. We just take 800,000, we multiply that by 80%, and we get 640,000. And this is what I call the global limit. Okay, so this is the maximum. Now, from that, let's just say these borrowers have an existing mortgage on their property, and they probably will. These are normally people like in their late 30s or their early 40s, and they may have an existing mortgage on their property right now for $330,000. Okay? So the math is simple. If the global limit that they can qualify for is 640, and they have an existing mortgage on their property for 330,000, again, we just do the simple math, and the available equity that they have for a secure line of credit is 310,000. And so now they have options, and they can choose what they want to use for the down payment. right? So that secured line of credit. So the question I sometimes get with this is, well, why not just refinance the entire mortgage and just get them a little, because the rates are a little bit higher on secured lines of credit than they are on mortgages. And it's more than just about a rate here. So you want to kind of keep, and let me just stop sharing this for a second. One of the things you want to do is you want to keep the secured line of credit and what you borrow for that other property separate from your actual mortgage. And the reason for that is the interest on the line of credit would be tax deductible. And also too, the property will cash flow. And the main reason why it will cash flow better is because the line of credit is interest only. Okay, so again, in this scenario, what you would do is you would use the line of credit for the down payment if in fact it is an investment property. Okay. Now, actually, I did have a really interesting conversation with a client just last week, and they had called me about purchasing a rental property, and they had actually inherited $150,000. And so now this is a little trick I'm going to share with you guys that are attending the webinar today. So again, I had a client who they had an inheritance of 150,000, and they said, "Oh, I want to buy a rental property because that has always been one of my goals, and I wasn't able to." So very similar situation as this example. So what I had recommended to them, and obviously you want to check with your accountant, but they can then take that 150,000, and what we recommended was that they apply this towards the current mortgage on the property. And so what would end up happening is they would they have an existing mortgage on the property for $330,000. They apply the $150,000 inheritance. And now the current balance on their mortgage is $330,000 minus $150,000. Okay, so now their balance is on their existing mortgage, so their personal debt is only $180,000. So then what's left to invest? This is where it becomes really cool, and this is why you'll want your clients to talk to us about this. Is now they have, again, the global limit is still $640,000. They have $180,000 new mortgage. But the available equity in the property that to invest is 640 minus 180, which is 460,000. So now they have 460,000 available as a secured line of credit to invest, right? So this really sort of changed the conversation for these clients because now they can purchase 2 rental properties. Right, so it's just a little trick, and I mean, we would work in conjunction with the borrower's accountant just to make sure that this was the right strategy. Now, one of the things that the clients did tell me though is like, oh, you know what? I have a prepayment on. I can only pay $100,000 up to $100,000 on this mortgage a year because of the prepayment clause. So they'd have to pay a small penalty on the $80,000, but I'm like, who cares? Now my mortgage is $180,000. So what if I have a $2,000 or $3,000 penalty to pay? The actual debt that I have to pay personally now that I'm sort of responsible for is $180,000 only versus $330,000. So they really like that idea. I do have another question that I'm going to just ask here. So, it's just a building on the question. So common ownership, 10 owners have 10% interest in total properties. This seems like a very complicated question, and I certainly appreciate it to whoever has given me this question. One of the things I can tell you is I'm happy to chat with you offline because I don't want to bog down the webinar. So if you can just connect with me afterwards, you can just email me, or you can actually go to my website at skipthebank.ca and book an appointment. I do have another question from Will Ensign, so thanks, Will. With 150,000 top up on the mortgage, is that only if this is allowed? So, Will, the question from one of the participants is, can we, is this $150,000 allowed? And I would say yes, of course. I'm not sure what the restrictions on that would be, but anyway, we would work in partnership with the client's accountant to determine that. And yes, Will, it would depend on the mortgage contract. Thank you so much. So let me just double check the time. I've got 12:20 right now. I wanted just to, let me just have a look here. I wanted to do some screen sharing and show you what's happening with mortgage interest rates and talk to you a little bit about the bond market. So again, for those of you who are interested in chatting a little bit more about this, you can always reach me at my website at skipthebank.ca. I have a really great tool on the bottom right-hand corner. You can just click on it and you can schedule a 15 or 30-minute consultation. And I'm happy to answer any questions that you may have, or you can just simply email me or call me. Okay. So let me just do a screen share with you guys and look at what's happening with 5-year fixed rate mortgages. I think you'll find this really interesting, and this is a really great way to wrap things up. So I hope you guys can see this. I think you can. So one of the things that we track, so I'm doing a little bit of a just changing gears a little bit because I wanted to talk to you a little bit about what's happening with mortgage interest rates because I think there's some misinformation out there. So one of the things that we look at, and this is very, you could do this as well. So I'm sharing you with you my tricks of the trade. We look, this is right from the Bank of Canada website, and we look at the different bond yields. So if you go to the Bank of Canada website and you just Google 5-year bond yields or selected bond yields, you'll see something like this. So it's a really neat graph because when you get the graph, you'll see all the different terms for the bonds, and then you just sort of have to click things off. And what I wanted to show you here is what we look at. So the Bank of Canada, so you have to remember that the bond yield affects 5-year fixed rate mortgages, and the variable rate mortgages are affected by the different mortgage prime rates that are impacted on the overnight lending rate. So remember, there are two different things. There's the bond market, affects fixed rate mortgages, and then there's the overnight lending rate, which affects the prime rate, which then affects variable rate mortgages. So what we saw in the last 2 weeks is that fixed rate mortgages have gone up, but variable rate mortgages have gone down. Okay, so let me just explain this to you because I think there's a lot of, people aren't sure about this idea. So you could see here, when the bond yield goes down, 5-year fixed rates go down. Okay, so you could see here, right, June 2020, look at how they've tracked down, 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 down. And really, you can see here since the middle of July into August and all the way up until pretty much, the middle of February, bond yields have been very low. Right. And one of the main reasons for that is that the government had sort of a buying back for bonds. And so it kept the yields low. That was a part of sort of the fiscal strategy around COVID and the Bank of Canada. But you could see here that, they are talking about easing some of those buyback the buyback that the government is doing. And then there's also sort of the risk of inflation in the US. So what we do know is when the bond yields go up, So do the fixed rate mortgages. So up until sort of the middle of January, for example, on a insured purchase, or a purchase, fixed rate mortgages, I was doing some fixed rate mortgages at 1.49% on a 5-year fixed. Right now, most institutions are at 2.09 to 2.29. I am seeing mortgage pre-approvals as high as 2.49%. So again, this is so we know that usually what happens is when the bond yields go up, in a week or two, so will fixed rate mortgages. So that's an important point. Now, I wanted to also have a look at some of the rate sheets that we're seeing. Again, I'm sharing these rate sheets. So at the Mortgage Center, the really cool thing about working with us is we not only work with wholesale banks like First National, they're sort of like the wholesale division of RBC. We do mortgages for MCAP. They're kind of like the wholesale division of Bank of Montreal. We do mortgages for TD and Scotia and also for Meridian Credit Union. So what I'm going to spend the last 3 or 4 minutes with you is just showing you sort of what's happening with interest rates so you can kind of see a really good comparison against wholesale or monoline lenders, banks, and then credit unions. And you'll see they're pretty much the same along the board. So again, here we go. The prime rate, remember the prime rate affects 5-year fixed, 5-year variable rate mortgages. And then we have here the Bank of Canada benchmark rate. And what this benchmark rate is, just as a reminder for you guys, is that's the stress test rate. That's the rate that we have to qualify all A borrowers on if they want to get these rates. So remember, we've got 3 different categories here. We've got high ratio insured mortgages. So these are the mortgages where many of your first-time home buyers or some of your self-employed people would be buying. There's a really great stated income program for those clients who are buying and don't show a lot of taxable income on their income tax returns. We can actually state what's reasonable for their income. Okay. So again, we've got stated income and just sort of the general high ratio. So you can see here, still excellent rates. But here, this is interesting. So the way that you read this is prime 2.45 minus 1%. So remember how I said fixed rate mortgages have gone up, but variable rate mortgages have gone down? It hasn't anything to do with the prime rate, it's the pricing on variable rate mortgages. So 2 weeks ago, the pricing on most variable rate mortgages was prime minus 0.5 to prime minus 0.75. So here you see on these high ratio purchases, prime minus 1. And then you kind of sort of have a plethora, depending on the loan to value. And remember, these are people with impeccable credit scores, 680 or more. This is what they're getting. And then these rates down here are for either owner occupied purchases or you can see rentals. And then what's really interesting here, the reason why I'm showing you this rate sheet, First National is one of the wholesale banks that we look at, but you can kind of see the difference between the different terms. Okay, so that's First National Financial. Let's have a look at Scotiabank now. And again, I know this might be of interest to some of you, so you guys can, those of you who are interested in this, you can just leave and contact me through email or through my website. So this is really interesting. So this is as of March the 11th. So this is our Scotia rate sheet. So you could see here what the rates were before March the 11th. Right, again, and just as of March the 11th, which was a few days ago, you can see how they've increased, right, on a 5-year fixed. And then you can see here, again, for the variable rate, you're looking at P. So Scotia's prime rate is 2.45. TD's prime rate is 2.6. Okay, so you can see the discount here, prime minus 0.7. Now they do have a few rate specials, unpublished rate specials, but they're very, again, you can see here that, again, this is a really great demonstration of how the fixed rate went up. But do you see here how the discount off of the prime rate has forced the variable rate mortgage to go down, right? And then these are what we call the uninsured specials, right, for people refinancing or having a 30-year amortization. Okay. And then lastly, just to kind of wrap things up, we do mortgages for credit unions. We do mortgages for your neighborhood credit union and Meridian Credit Union. So let's have a look at Meridian Credit Union's rate sheet. So give me a second here. So this is kind of interesting. So again, you can just really see the different options. So credit unions are really interesting because they have products where you have to qualify based on the Bank of Canada interest rate, the qualifying rate, that 4.7%, 4.79%. And they also have mortgages where you can qualify that you can qualify on the contract rate. And so right now for purchases, for those clients who are having trouble qualifying in the kind of correct, like in the right category, so they've originally been pre-approved for a purchase of 600,000, and now they may have to go to 700,000. We can probably get them a little bit more because through Meridian Credit Union, and the reason for that is they have a special product where they can qualify people based on the rate for the contract, not the stress test rate of 4.79%. So you can see sort of what's happening with interest rates there. So that wraps things up for today. I'm just going to do a stop share, and just thank you for attending today. As I said, I am recording this, so this will be available through GDAR. I did want to maybe just look at oh, I do have a question from somebody about basis points, like what are beeps? Oh, guys, I'm going to just wrap this up. Just to let you know, it takes probably about 20 to 30 hours to do a mortgage. And the way that mortgage brokers get paid is we get paid based on the loan amount. So if somebody has a $100,000 mortgage, we get paid $800. Okay, so that's what beeps are, basis points, and that just talks a little bit about how we get paid. So that's it for today. You guys have a nice afternoon. And again, if you do have any questions, I'm happy to help you. You can just email me, and you've got my email address when you registered, or you can also connect with me through my website. You can schedule a 15 or 20-minute consultation there at skipthebank.ca. Okay, thanks so much. Look forward to chatting with you again.